Good morning and welcome to the 5th annual Marie Selby Botanical Gardens Luncheon. To say this past year's been different would be an understatement. As you can see, there are no hugs, no friends, and no acquaintances reconnecting here today. It's just not the same here without you, and we want you to know that you're missed. The luncheon's always given us an opportunity to give you updates on the bank, economic outlooks, and introduce you to topics of interest. We want to continue that tradition of the Selby presentation, so we've gone virtual this year. Sit back, relax, and enjoy.
Afternoon or good evening, depending on what time of day you're watching the webinar. As Cindy Miller said, we miss seeing you in person, but appreciate you making time in your busy schedule to attend virtually. I hope you have a sun-brewed iced tea or favorite beverage handy to relax and enjoy our webinar. My name is Chris Strafford, Group Head of First Source Wealth Advisory Services. As many of you know, the Marie Selby Botanical Gardens in Sarasota has an annual art exhibit in the mansion, and the gardens are landscaped to match the artist being featured in the gallery. This year's artist is Roy Lichtenstein, featuring his pop art Claude Monet-inspired water lilies. Monet painted approximately 250 oil paintings of water lilies during the last 30 years of his life. The last series of 12 large-scale water lily paintings were designed to serve as a haven of peaceful meditation, with Monet believing these images would soothe the overworked nerves of museum visitors. I hope the Lichtenstein version from 1992 helps everyone on this call find a haven of peaceful meditation after the webinar today. For many of you who lived through the 1960s, these psychedelic images might bring back memories of the peace and love youth movement. I'll be asking a couple of trivia questions to keep you on your toes during the webinar. Please email Cindy Miller. If you don't know Cindy Miller's email address, it's millerc@firstsource.com. That's the number 1stsource.com, or text her at 574-274-4492. If your answer is correct, Cindy will add something special to our surprise announcement at the end of the presentation. Let's try one now. In what city's museum will you find the large 12 water lily paintings by Monet? In what city will you find them? Email or text Cindy. Each year, I highlight the First Source mission statement to kick off our event, to help our clients, businesses, and communities achieve security, build wealth, and realize their dreams. First Source Bank continues to strive to achieve distinctive convenience and provide straight talk and sound advice to our customers. Like Monet, we continue to strive for perfection. We're not satisfied with just meeting your needs. We want to anticipate your needs and be your joint partner. We've observed that many of our customers winter or retire to Florida. So we've opened an office in Sarasota so we can continue to service you while you're in Florida. We can also continue to serve as your trustee and personal representative in your estate planning documents, even if you change your domicile to the state of Florida to avoid state income tax and gain other benefits. At this time, I'd like to introduce Chris Murphy. Chris Murphy joined the bank's board of directors in 1972, became an employee in 1976, president and CEO in 1978, and added the chairman's title in 1998. Chris did his undergraduate studies at Notre Dame, received his Juris Doctorate from the University of Virginia Law School, and his MBA from Harvard. Chris has been very active in the community and has served on numerous local, regional, and national boards, and among others, continues on the Indiana Commission for Higher Education, the Medical Education Foundation in South Bend, and the board of directors of the Federal Reserve Bank of Chicago. Chris?
Thank you, Chris. It's great to be with all of you today. I've got to tell you, I was really excited to visit with you in live format instead of on a video format that you're watching when we were all supposed to be at Selby Gardens when Microsoft decided that none of us were going to visit anywhere across the country and we all got shut down. But we're here today and we're having a chance to visit with you. So it's great to be here. It's great to welcome you all. I also got to tell you that, the first value at First Source is integrity. And as many of you know, I dress in honor of my customers and honor of the people we're working with. And we are authentic, so I want you to know I've got everything on Even though I'm sitting in my home in Florida, it's the full suit for you. In fact, I'm wearing my artistic tie with the sun at the top and the bay of Sarasota right below it with the sailboats in it. So I'm trying to make sure that we're hitting all the dots here. My purpose really is to thank you all for being clients of First Source, to give you an update on the state of the bank, and then to give you some comments and observations about that I've developed in my capacity as a member of the Federal Reserve Board of the Federal Reserve Bank of Chicago. Let me start with the state of the bank. This is a remarkable year. It's all about people, teamwork, safety, service, and performance. As you know, this past year has been an unprecedented year. In fact, a year ago when we were all together, I was bragging about how well we had done the prior year. I talked about our historic earnings. We had just finished a meeting of our advisory council, our board, 3 days offsite session, planning for the next year. They had adopted our plan, blessed it, and said, go on out. We were going to have a better year this year. And then something happened. And, you know, really, when I was a kid, Sister Felicitas in the 2nd grade told me, Chris, whenever you let your pride get ahead of you, God will humble you. Now, I'm not going to take responsibility for COVID coming down on everybody, but I know that was a message from God that I was too prideful last year. So we have dealt with a year with dramatic change, and I couldn't be more proud, but properly so, of my colleagues and the way we've dealt with the COVID, what we did with it, and how we've served customers throughout this period. And I will tell you, we pivoted very quickly a year ago, just about this time. We said the most important thing are our people, both our colleagues and our clients. We want to keep them safe. That was the most important thing we could do, and to continue to deliver the good service we've always delivered. So we took precautions. We went around and said, what areas are critical to us operating in the future? And let's take those areas and separate them so we don't have all of the people in one critical area being at risk of being infected at the same time and having to go out of the bank and be quarantined and then leaving us unable to meet your needs or our client needs. So we also said we want to identify those who are high risk and make sure they're kept safe. So we had a self-selection of people who are high risk. Now we have about 1,200 employees, 170 self-identified as high risk, and we let them go home. We equipped them to go home. Only 120 decided to go home. We also went to all the other critical areas of the bank and said we need to equip them so if we have to leave, these people can work from home. But we continued to work in the office and people from the office. So we did those precautions first. We didn't allow any movement among buildings. We allowed no movement among floors in the main building or in the first bank building, so that we actually kept our colleagues and our customers safe. You remember we closed the doors to our branches. But we then handled people only by appointment. That was again so that we could control the number of people that were in the branch at one time who might infect somebody else. That has worked very, very well. So through teamwork, working with the pandemic team group, which is the pandemic team leaders who have been meeting 3 times a week over the last year. Originally, we're meeting every day of the week to deal with the challenges. Now, what about the business? Well, a year ago at this time, we thought we were going into a really, really deep and dark tunnel. And that was happening in the economy. As you may recall, businesses were being shut down, states were being shut down, people were being told to stay at home. And there were big things happening, bad things happening in the economy. And the first thing that did, the Federal Reserve stepped up and started lowering rates so that it could provide fuel to the economy. It encouraged the government to take fiscal actions to, in fact, stimulate the economy. And as you may recall, a short time later, there was a major fiscal package passed, which introduced a whole set of programs across the economy to make the economy work. And as a result of that, things got a whole lot better. You know, we had the stimulus checks that went out to people across the country and across our markets. We had the PPP program, the Payment Protection Program, which helped businesses retain employees, keep them employed and keep those businesses alive to get through the pandemic. And now we've got a second round of all of that. And in fact, at First Source, we embraced these very, very quickly to utilize them. So we actually ended up doing 3,450 loans, PPP loans to clients in the first wave, $597 million to our clients so they could keep their employees employed, paid in the markets we serve, and that they could continue to be able to come out of this when things got better. We also deferred almost, well, over $1 billion worth of loan payments in either interest or interest in principal. Today, those deferments are down to about $160 million. So those clients got through the problem with the help of PPP and our deferral program, us working with them. So they are now poised and ready to come out well and strong, and many are already doing so. We did about over $500 million worth of mortgage production last year, an historical mortgage production for 2,200 clients who either refinanced their homes or they bought new homes and moved up in terms of size. So it was a very successful year in that sense. And on the financial side, we ended the year as our third best year in our history in spite of COVID. We ended the year with strong reserves, strong capital, very well positioned, credit under control, obviously some challenges in credit, but under control so that we can move forward well and be good into the future. Now, we're as lead managers in the bank, we're paid to think about the future, to look down the road and around the corner and try to figure out what's going on. And I'm thankful that the team in WAS does exactly the same thing for you. Our investment managers, our account supervisors are all looking down the road, around the corner and saying, how can we help you? They take a long-term view, just as we do in running the bank, a balanced position so they're responsive to the challenges today, responsible to you and making sure that you're protected in the long term. So the state of the bank is very strong, in good shape. We're continuing to go forward. And in fact, we just finished our 33rd year of increasing dividends, which puts us in the top 1% of publicly held companies in America. We are very, very proud of being able to continue to increase our dividend year after year and have done so for 33 consecutive years. So, you know, as we look now forward to the economy and the Federal Reserve, I guess I want to give you first my view on a short term. You know, when the Fed responded to COVID, it was concerned about its mandate, its dual mandate, which is inflation and employment. It wants to keep inflation under control and employment at its maximum or highest level possible. With the COVID, employment was being hit very, very hard. Inflation was not yet really impacted. And if you look back over the past few years, we had the crisis in 2008, and the Fed then provided a lot of stimulus to the economy using its what they called QE1 and QE2, the quantitative easing, and changed their balance sheet dramatically. It was about a $1 trillion balance sheet. They moved it up to about $4 trillion during that period of time, so as to ensure that the economy got better. And it did. If you looked at 1918 and 1919, the highest increases in income and the largest increases in percentage employment was occurring at the lowest level of the economy, at the people at the lowest level of the economy, which is exactly what they were trying to do, to bring everybody into success in the American economy. And then COVID hit, and the people who got hit the worst were exactly those people. They were people who come from the lowest level of income, the lowest level of education, that are in personal service businesses, whether it be hospitality, event, barber, beauty salons or whatever, and they were hurt the most. So the Fed said, what do we do? Well, first we need to make sure that the markets continue to function, and they provided an awful lot of capital to the market in terms of liquidity, and took while they were bringing their balance sheet from $4 trillion back down to $3 trillion at the end of 2019 to try to extend the growth of the economy. When COVID hit, they went right back up past $4 trillion to $7 trillion in their balance sheet and applied that money into the marketplace. So they were looking at huge losses as COVID hit. Wall Street was in chaos. The Fed led by providing liquidity or grease, oil to the markets, and they encouraged fiscal stimulus from the federal government. I want to say one thing that I think is very important to understand about the Fed. It is absolutely apolitical. Everyone I have met has over and over again said, we don't pay attention to the politics, we pay attention to the numbers, and what we can do to make sure we deliver our dual mandate, whether it be the dual mandate, the inflation mandate, or the employment mandate, and we're trying to balance those. So they actually acted in an apolitical way to do that. They got a lot of pressure from one side of the political spectrum, other pressure from the other side, and it was all about what are we doing right to deliver on that dual mandate. So they provided money to the economy at a very low cost. They encouraged Congress to introduce fiscal stimulus, which it did. And then they set up a whole set of programs to back up that fiscal stimulus, providing liquidity, whether it was swap programs, repurchase programs, derivative backup, just liquidity that made sure the economy would work. And then they went and became a lot more transparent about what they're trying to do about rates. So they speak to the market and say, we are staying at this rate level until we get to reaching our dual mandates. We've got to get to an inflation rate that is around 2%. We'd allow it to go above 2% now. And we want to get to a 4% employment rate at a minimum. So they're trying to drive both of those. Now, that's the short term. I think the Fed has been absolutely miraculous at what it's done in the short term. And I could not argue with anything they've done, even though as a banker, I might like higher rates. It's been the right thing for the economy. And it's a short-term solution. I am worried about the long-term debt we've created and what that means for all of us for the long term, and what kind of dislocations there will be in the market now and into the future, and what the government will have to do on the fiscal side to pay back that debt. So it's really now about the markets for the long term, and that's where my colleagues come in. Just as we at First Source have to look at the long term and the way we manage our balance sheet on the asset liability mix, my colleagues, Paul Gifford, Eric Clapsdale, Rob Romano, who you're going to hear from, are all worried about you for the long term. They've got to make sure they're paying attention to the short term, the things that are going on in the short term, but they've got to be helping you think about the long term. So, we've got a government that's probably not going to be as friendly to wealth building as we've had historically. So you need to be thinking about that. We need to help you think about that. There's going to be more volatility in the markets going forward, so we need to help you work through that. And then many of you want to pass this on. You either want to contribute it to charities of your choice, or you want to pass it on in your family. And that's why Kurt Thompson and Justin Cohey are here talking about what you do to protect yourself in the long term. They're important players in the First Source team, as are all of our account managers and our investment managers. So they've helped me and my family think about the long term. How do we protect what we have now and continue to build it for the future? Just as my responsibility is, how do I protect what we have now in First Source, and how do we build for the future at First Source? We don't want to take it away by taxation. We don't want to take it away by confiscatory government activity. So we've got to move in a protective way, but we've got to be balanced. So, I think on the one hand, we're doing well. The Fed's been very helpful. The economy is doing well. We see a lot of positives in the future, but we also have to be wary where COVID's going to go and how we deal with the long-term impacts. Lastly, I want to thank you all for the opportunity to serve you. We are successful because we've had the opportunity to serve you as a client, and we thank you for giving us the honor of serving you. We look forward to serving you for many years ahead, for generations to come. As you know, if you don't have it, my cell number is 574-286-4451. Last year, somebody texted me while we were in the meeting, wanting to know if I really answered those texts or ever answered those calls. I do. And if we're not meeting your needs, please let me know, and we'll try to find a way to make sure we're doing so. So again, I couldn't be more proud. And if you read my shareholders letter, which I know you're just waiting with bated breath to do so, it's all about the people here. It's all about how the people came together to serve you, our clients, and to keep you and each other safe. So again, thank you to you, and thank you to my colleagues, and I'll turn it back to Chris.
Thank you, Chris. I appreciate your comments. I picture at the luncheon, at this point, when you're usually done at the podium, people start raising their hands and asking you questions. Well, we did have some clients submit questions when they registered for the webinar, so I'd like to direct one to you. What do you think will be the biggest change to banking over the next 10 years?
Well, I think the biggest change to banking is already occurring, and that's the digitalization of banking and real-time information and real-time movement of money. You're going to see a lot faster movement of money into the future. So the technology will continue to change. But what we do really doesn't. At the base level, we're an intermediator. We take money from people who have it and then help lend it to others, but make sure we get it back so that we get it back to the people who have it. So we are the trust factor in between. We will still be doing exactly the same thing. You know, there are all these platforms now where people are making loans to each other, and then they're finding out they're not being paid back. Surprise. That's why we are where we are, is we help move money from places where there is a surplus to places where there are shortages, but it's properly used so it can be paid back and given back to the people who then provide it. So I would say that the big change is going to be you're using the mobile phone, being able to transfer money instantaneously among people, among companies. So it'll be technology continues to change the business, which just makes it faster and faster and faster. I think the other thing that's going to be really different is the plethora of opportunities that you'll have for service, and just how many people are going to get taken by the fraudsters out there thinking they're getting something that's too good to be true. And by God, if it's too good to be true, it is too good to be true. And I think that's the bigger change. We're seeing fraud explode with technology, just explode. And the older people get, the more they're trusting, and they believe an email they get, or they believe a text they get, and then they get sucked into problems. And so I think it's us being a lot more proactive about protecting our clients and us using technology to serve them while also protecting them with it.
Thank you, Chris. Really appreciate your comments. And I look forward to looking over Sarasota Bay next year when we do this next time. So thank you.
So do I. I can't wait to be with everybody.
Second trivia question, again, email or text Cindy Miller. You're going to see a painting of a BMW 320i that was painted by Roy Lichtenstein in 1977. So the question is, the circular BMW logo symbol attempts to represent what? And there's more than one answer here, but please send your answer. BMW logo represents what? Send it to Cindy. Now I'd like to take the opportunity to introduce Paul Gifford, who is our Senior Vice President, Chief Investment Officer, and Chartered Financial Analyst, along with Eric Clapsettle, Vice President, Chartered Financial Analyst, Certified Financial Planner, and Director of Fixed Income Research, and Rob Romano, Vice President, Chartered Financial Analyst, and Director of Equity Research. Paul?
Thank you, Chris. As Chris Murphy talked about, it was a little over a year ago that we were in front of 300 of our clients, guests, and colleagues. And at that time, I was sharing a variety of yellow and green beach flags, trying to represent our thoughts on a variety of investment topics. At that time, I'll be honest, I had coveted as a yellow. Little did we know at that time that the S&P 500 would promptly fall 35% over the next 23 trading days. I would say I didn't quite have that yellow flag right. But what's good about how we invest money is that we've done it through a variety of bull and bear markets created by different conditions, and the pandemic was yet a new challenge, but just another condition we had to work through. And what we have done over the decades has built an investment philosophy where we have been working with our clients as the primary objective. Chris talked about it earlier, the importance of our clients. And the focus of our philosophy is the client. What is your needs? What's your objective? What does your family need to accomplish? And even simple things as understanding your cash flow needs can help us build better portfolios so that you don't need to raise money in the middle of a pandemic when the markets are down. The second part of that is investing for the long term. In the next 5 or 10 years, it is very likely that the pandemic drop we saw in March and April of 2020 will be a blip on the S&P's chart. And by taking that philosophy, investing for the long term, we can truly help our clients work through difficult markets. We also know that markets move through cycles. And obviously, we had a very difficult cycle earlier a year ago. But today, it's a fairly robust market, and we're actually seeing shifts in where investments are performing better. And so we're trying to take advantage of that as we go through market cycles. Fourth, it's really about diversification. I think back during the pandemic and when the markets, equity markets in particular, were going down, we had a strong, high quality fixed income portfolio that we could go to if clients' expenditures all of a sudden had to surge. And we had a couple clients who that happened, and we were able to meet those needs without having to sell equity markets at the lows. Lastly, this is one that really came out of the tech bubble in the late 90s and early 2000s, is we watch investor sentiment. Investors get bullish and bearish, and sometimes to extremes. And what we have learned is by watching that, that can give us clues to what the market might do over the short term, and that can help us drive some of those tactical decisions. Today, the market's looking ahead, and it's looking at very good news. As we're doing this recording, the stimulus bill of $1.9 trillion was passed yesterday, and it's entirely possible by that tomorrow there could be checks in certain clients' accounts who had electronic deposit of their refunds in previous years. Second, we believe that there will be an infrastructure spending bill sometime in 2020, which would put additional money into the system. One of the interesting things that's come out of the pandemic as far as financial is that Americans have increased their savings rate. Savings rate has almost doubled in the last year, and that's added $1 to $1.5 trillion into savings accounts. And our belief is that once the economy is open and people are more comfortable with their financial situations, that money will move back out and be spent or invested. Either way, that would be good for the economy. Lastly, as Chris talked about, the Fed is accommodative, from increasing their balance sheet to keeping interest rates low, and we believe that will continue for a period of time. Now, with all of this good news, we truly do not believe this will be a smooth path to higher equity prices and a roaring economy. We're going to have volatility, and that volatility could be in stock prices that fall 5, 10, or 15%, or it could be that we have issues with COVID and the economy doesn't open up as fast as we think it could. So expect some volatility along the way. Now I'm going to hand it over to Eric and Rob to cover a little bit more on our fixed income and equity outlooks.
Thanks, Paul, and hello, everyone. I'm going to take a few moments here just to provide you with our outlook on interest rates, where we see them headed or not headed. But I would be remiss to not mention that we have been closely watching the fixed income markets. We always do, and interest rates have moved back up. For instance, the yield on the 10-year Treasury is much higher than where it was a few months ago, but on a relative basis, it's back up to where it was in early 2020. So why we think interest rates are gonna stay lower for longer, or will stay lower for longer, is for really just three main reasons. And there's other reasons as well, but these are really the three driving factors. And first and foremost is really just the unprecedented stimulus from central banks around the world. And to be more specific, as was previously stated by both Chris and Paul, has been the Federal Reserve's balance sheet. It has reached in excess of $7 trillion now. They did it to shore up the financial system. What is inside of there is U.S. Treasuries, government mortgage-backed securities, and then upon the most recent pandemic, as liquidity became an issue, and as price discovery appeared to leave the markets, things like investment-grade corporate bonds were bought, municipal bonds, investment-grade municipal bonds. Investment-grade bonds that got moved to junk credit ratings were purchased by the Federal Reserve. And really, the most obscure one to date has been the purchasing of fixed income exchange-traded funds. Exchange-traded funds are securities that trade like stocks, but are diversified similar to mutual funds. But all these things were purchased really to provide liquidity to the market and to drive down interest rates to stimulate the economy. Secondly, there is still about, depending on the day or the week, there's somewhere between 12 and $18 trillion in negative yielding bonds around the world, not in the United States, but in Europe, Japan. And just because there's negative yielding bonds certainly does not mean that interest rates in the US are going to stay lower. But what it does is it drives foreign investors to move their investments, certainly the fixed income investments, to the United States, to own yields at significantly higher rates. And to put that into perspective, one of my favorite places to go is Switzerland. 50-year government bond yielding today about negative 0.1%. So you get to lend Switzerland your money for 50 years and pay them 0.1% annually. Again, just really a core reason why we think foreign dollars are going to find their way back into the United States. fixed income markets. And last, and really the most important reason, again, kind of addressed by Chris and Paul as well, is really the Fed's decisive decision to keep interest rates low, to keep their target rate basically at zero. And on top of that, buying bonds in the secondary market. But what's going to drive the Fed to move rates higher is going for them to meet and exceed their dual mandate, which is one, full employment. To put in that perspective, right now the unemployment rate, the headline unemployment rate is at a little over 6.2%, but sort of the more all-in unemployment rate, which is the underemployment rate or the augmented unemployment rate, today sits between 10 and 11%. And the Fed always likes to talk about slack in the labor markets, and that's the number to go to when you want to see, hey, what's the slack look like in the labor market? So there is going to be, on the labor side of things, even though it's certainly improving, it's going to need to improve substantially from where we're at today before that receives a check. And then price stability. The Fed, again, has been clear. It's not been an issue over the past decade, but they want core inflation to average or slightly over 2% for some time before they feel prompted to do something with interest rates. And I think we've heard it from, we've heard it from Jerome Powell, chairperson of the Fed, that he is not ready to move interest rates. Specifically, his most recent comment was, when the time comes to raise interest rates, we'll certainly do that. And that time, by the way, is no time soon. I will now turn to Robert Romano to provide us with an outlook on the equity markets.
Thank you, Eric. So when we think about the equity markets at First Source, we believe there's really two main factors that really drive equity prices. One being the Federal Reserve and monetary policy that Eric highlighted so well. The second being corporate profits. And with corporate profits, we've seen this dramatic recovery throughout 2020, which we think will continue into 2021. Now, the low point was the second quarter of 2020 when S&P 500 profits fell 36%. Third quarter, they were down roughly about 9 to 10%. And fourth quarter, they're actually coming in positive. So really a big recovery throughout the year. In addition to that, 80% of companies exceeded analyst expectations when it came to those earnings in the fourth quarter. So why are we seeing this dramatic recovery in corporate profits? We think there's a couple of factors here. One is the ability of these large companies to access the credit markets. Last year, there's $1.7 trillion of investment grade debt that was issued. That was a record, up 54% over the prior year. And a good example here is Johnson & Johnson. So way back in 1999, they issued a 30-year bond at 6.95%. Wouldn't it be nice to have a coupon of that rate in this environment? But more recently here, just this past August, they issued a similar type bond, 30-year bond, at 2.25%. So that interest rate difference is significant, and it goes straight to the bottom line. Secondly, these large companies had the ability to right-size their business, realign their business model to the new reality, invest in technology to become more productive and more efficient. And a good example here is Whirlpool. In their latest quarter, their operating margin was up 3% year over year to levels they've never seen before. So in 2021, we believe we're going to see a sharp increase in corporate profits. Next, I'd like to talk about the equity markets and kind of give you our thoughts there. But first, I'd like to take a step back because what a year it was. We had a bear market and a bull market really within 1 year. And when you think about a lot of your major declines in the equity markets, many of them are these unexpected events that really come out of nowhere. And last year was definitely that with the pandemic. And as a result of that, the equity market fell 35% in 23 trading days, fastest bear market ever. But after that, we had one of the fastest recoveries ever. From a bear market low to a new high, it took 5 months to get there. In 2008, the global financial crisis, it took 4 years to get back to a new high. So where are we now? We're roughly about 75% off the lows of March 23rd of last year. We've made a very big move here. We think a lot of that good news is in equity prices. Again, that doesn't mean the market can't go higher. We think it can, especially when you compare it to, where rates are. Rates are still at very low levels. But we want to be mindful of valuations. And in this chart here, you can see that the forward price to earnings ratio on the S&P 500, which is a measure of valuation, is at roughly around 22 times earnings. And that's elevated by historical standards. You really have to go all the way back to 2000, 2001 to get back to similar levels. In addition to that, the initial public offering market, in our mind, is a bit overheated. And investor sentiment is a little over bullish. And, Paul highlighted that earlier. So we would expect to see, a pullback along the way here. But again, that'd likely be a buying opportunity, just given the, the amount of stimulus that's out there really in the economy right now. Lastly, I'd like to talk about growth equities versus value equities. And we've seen really a record move in these growth stocks, really since 2009. But, in 2020, we saw the largest relative performance of growth stocks over value stocks really in history. The Russell 1000 growth is up 38%. Russell 1000 value was up only 3%. And the return in those growth indexes was really due to a lot of these big cap technology stocks. These names we all know so well. The Apple computer was up 80%, Microsoft up 41%. I mean, these companies have terrific brands. They're leaders within their industries. They have huge economies of scale. They're very dominant in what they do. Another name, much closer to home, Eli Lilly. They have a leading diabetes franchise. They pivoted very quickly to develop therapeutics for COVID, and they have a top candidate for Alzheimer's. But more recently, what we have seen is value stocks have done better. And this really coincided with kind of the change in the administration, the effectiveness around the vaccines that we heard about back in November from Pfizer, Moderna. And, financials did better. Energy stocks, some of those reopening companies did better. And small caps had their best quarter in history. That was the fourth quarter of 2020. So we believe that some of these big cap technology stocks will take a bit of a time out, and some of these other names more tied to the improvement in economic growth will do better. So in summary, the market has made a very big move here, and we think there'll be pullbacks along the way. But again, those will likely be buying opportunities, just given the amount of stimulus that's out there, and what we believe is going to be a sharp improvement in corporate earnings.
Thanks, Rob. Thanks, Eric, and thanks, Paul. We do have some questions that were submitted when people registered. I'm going to direct one to Paul right now, and we'll do some at the end of the webinar. Paul, the question is this a good time to buy gold?
Actually, it's been interesting that we've had that come up a lot more frequently, especially as we've seen the surge in government spending and increase in debt. And historically, we kind of think of gold in two veins. One, when inflation is going much higher, gold has tended to do well. And when there's fear, gold has historically done very well when markets have been fearful. And if you look back at our comments over the last 20 minutes or so, we actually think the economy should do pretty well. And so there shouldn't be a lot of fear on that front. And as far as inflation, now we might see some here in the interim, but we think longer term that should be well managed with what the Federal Reserve is doing and how they keep their eye on it. So while gold has come up in conversations with clients and in our investment committee, at the moment, we're not recommending any allocation to gold.
Thanks, Paul. Well, when it comes to charitable planning, the First Source Bank Family Office assists many of our clients with creating a legacy through charitable giving. I'd like to introduce Kurt Thompson, CPA and Managing Director of the Family Office. Kurt also partners with Justin Cohey, Juris Doctorate, Assistant Vice President of the Family Office. Kurt?
Hello, everyone. It's good to be with you, even though it's virtually. And as some of my colleagues have already mentioned, I'd rather be there face to face, and hopefully soon we can be face to face, and especially look forward to next year having this event again in person in Selby. I wanted to talk to you today and spend some time briefly discussing a topic that's certainly very important right now in the world, and also with our customers. Between the pandemic, social unrest, natural disasters, and especially high unemployment over the last year or so, there's been a tremendous demand and stress on charities to get donors to step up and give. And if you look at statistics over the last year, a lot of donors and people across the nation and around the world have stepped up. I'm asked all the time, and it seems to be a more frequent conversation nowadays with the demands on donors, that where do I give and how do I get started? And I've tried to advise people over the years and come up with what I think is a fairly simple 5-step approach to charitable giving that hopefully will be helpful for me to share with you today. The first is really sitting down and prioritizing your giving. Take a look at what causes and issues are most important to you and your family and your own personal experiences or challenges that you have been through. And then you have to decide also how you want to give that gift, where, locally, nationally, globally, or a combination of those types of things. And once you have that priority established, secondly, you need to choose the actual charity or charities that you're giving to. And it's a difficult task, to say the least. There are thousands of charities out there, and charities approach causes or issues in different ways. And there's really no right or wrong answer. But what I tell people is do your research, do your due diligence on the charities you're looking at. There are many online resources available to donors nowadays to look at a charity's mission and their programming and how they're spending their money. The charity's own website oftentimes is a good resource for you to dig into and look at. And then I also advise people talk directly to those within the charity, maybe running that program or the management of that particular charity, as well as maybe other donors you're aware of or in your circle of friends that may have their own personal experience with that particular charity. Once you've chosen the charity, then consider your options for giving. You can either give your money or your time through volunteering. Obviously, with the pandemic over the last year or so, volunteering has been very restrictive or almost non-existent. So it's an easy way oftentimes for people just to give money. And the easiest form of that is cash, direct cash gifts to a charity. However, most all charities I'm aware of nowadays will accept and are taking non-cash type gifts, such as stocks, bonds, certain types of real estate, things of that nature. And oftentimes these are assets that you or your family may hold that you've held for a long period of time that have a lot of built-in appreciation in that particular security. This may be a more tax efficient way for you to do your gifting without limiting or affecting your liquidity. It may be both not only an income tax efficient way to give that asset, but also from an estate tax perspective. With the talk of higher capital gains taxes in the near future and higher estate taxes, this oftentimes may be a way for you to consider giving a more tax efficient gift. The fourth thing, as I always tell people, is plan your gift. Sit down with your team of advisors, your financial and tax advisors, such as your CPA, attorney, and specifically us here as First Source as your trust administrator or investment advisor. We can help you with the type of giving and also the timing of that gift to help you maximize your benefit. The last thing is really do something. I tell people all the time, don't get caught up necessarily in some of the minutia, but there's no such thing as a perfect gift to the perfect charity. Start doing something today and make an impact. Now I'd like to turn it over to my colleague Justin Cohey, who's an assistant vice president attorney in our family office, to talk to you specifically about a tool that we're providing our customers through our donor advised fund service, which really is assisting families and donors in their charitable giving strategy and mission. Justin?
Thank you, Kurt. As many of you know, and as Kurt mentioned, 2020 was, and the beginning of 21 has proven to be difficult for many individuals as well as charitable organizations. In order to help some of our clients, last year we introduced our donor advised fund program. So I'd like to spend a little bit of time just explaining how a donor advised fund works. Now, you as the donor would work with us to establish and name your account, and then you make an irrevocable gift of either cash or appreciated securities to fund that account. As was mentioned before, if you do so with appreciated securities, you avoid any capital gains, but any type of gift will garner you an immediate income tax deduction, as well as get the assets out of your name for estate tax purposes. Now, some people get nervous that when they hear the word irrevocable and believe that that means that they are relinquishing control, but that is not the case here. With the donor advised fund, you are named as the grant advisor, and you are able to work with Paul and his group to recommend investments, and you will be able to determine what grants are made to what organization and how much. It's really entirely up to you. And because you are able to name your successor grant advisors, you are able to pass along that charitable legacy that you have started. Since we introduced the donor advised fund back in 2019, we are now managing just around $4.5 million across an excess of 30 accounts. With 2020 being as difficult as a year as it was, we saw the amount and number of grants explode. In fact, over $1 million went out last year to 100 different charities and organizations, which was a really nice thing to see in a difficult year. As Kurt mentioned, this is just one of many ways that you can to give to needy organizations. So I suggest that you contact your administrator and other team members to help determine what the best tool is for you. At this time, I'd like to turn it back to Chris Stratford for our Q&A. Thank you.
Thanks, Justin. And the first Q&A question I have is going right back to Kurt. Kurt, the question: what, if any, new tax law changes will impact us in 2021?
Great question. Really, as we stand here today, there are no major changes to the tax laws. Obviously, there's much discussion about what will happen in the near future. We are obviously, our tax department and all of us here in the Wealth Advisory Services area are taking a close look as we hear about potential changes, but there's nothing major in place right today. The big question becomes really entering into the beginning of next year and beyond, which is highly likely that we'll see some major changes to income tax rates and also estate tax exemptions and rates. The only thing that I will mention today is that there was a waiver of the required minimum distributions for IRA accounts that was in place for 2020. That went away at the end of last year, and that people are required to take out their required minimum distribution during 2021, but keep in mind that there's still the potential to be able to give that required minimum distribution away to charities and to avoid any income tax on that. So it's a tax planning tool. But I did want to mention that waiver has been lifted for this year so far.
Thanks, Kurt. I remember this next question was one of the first that was submitted when we opened up the webinar for registration, and it goes to Cindy Miller. Cindy, what are the top 3 considerations for living as a retiree in the state of Florida?
You mean besides the weather? The most notable benefit is that there's no state tax, and this of course is beneficial for each individual's personal tax situation, but it's also important for estate planning. Mentioning estate planning reminds me to remind all of you to remember to have your documents reviewed for Florida compliance as you relocate. It's also important to complete the appropriate domicile, and I know that we've mentioned this before, but the domicile steps as you just establish your residency. And one of the things we have here in the office is a really nice publication that can assist you. So just give us a call and we'll get one to you. And the last is that your wealth advisory team continues to be here for your trust, your estate, and your investment planning as you relocate to Florida. I know you've all heard me answer this question before. Why are you in Florida? And I will always respond, we're here because you are here. Back to you,
Cindy.
Chris.
Thank you. Next question, Rob Romano. What is the appropriate exposure to the equity markets?
Thanks for the question, Chris. This really gets to our portfolio construction process, which is how we build investment portfolios at First Source. And the process is really twofold. One, it starts with the creation of an investment policy statement. And an investment policy statement details all the unique characteristics of each client, such as the return objective, the risk tolerance, liquidity needs, tax situation, time horizon. All those factors are important in determining an optimal equity allocation. Secondly, is all the work going on behind the scenes at First Source through our asset allocation committee and our 3 investment research teams, which is really supplemented by the research from our external partners. So this process, through these 2 factors, really help us develop a prudent equity allocation for each client.
Thanks, Rob. The next question is it's a three-part question. I'm going to direct it to Justin. Justin, what do clients like best about the First Source Donor Advised Fund? And second part, how easy is it to make a donation or grant?
Well, I think the second question kind of answers the first question. What I think a lot of our clients who are using the Donor Advised Fund are really enjoying about it is the simplicity. You can make a large gift in 1 year and pre-fund some of that giving, knowing that you can get that income tax deduction and carry it over for 5 years. Just because you have the money in a donor advised fund does not mean that you have to give it away right away. So the clients are really enjoying being able to take that extra time to kind of plan and see what happens over the next several years and what becomes more and more important to them. One thing I'd like to mention, with technology becoming a major player in the banking and financial industries, is that our donor advised fund is mobile friendly. So say you're at an event, hopefully in the future when you're allowed to attend them, and meet someone and become passionate about an organization, you can pull out your cell phone and make a gift right then and there. So I think simplicity is the biggest thing that people are really enjoying about it.
That's great. One more follow-up question about the Donor Advised Fund. What metrics are used to determine which charitable organizations are most impactful at carrying out their mission?
Well, I think Kurt made a really good point in that you need to do a little bit of research and looking at the financials of a charitable organization, asking for a Form 990, just asking to see any type of financials because they are required to share those with people who are asking those types of questions. One resource that I'm using a lot, just even for obtaining basic information on charitable organizations like addresses, phone numbers, and tax identification numbers, is a website called Guidestar. And one other thing that Guidestar is doing, and this works into the question in terms of metrics, is that they are awarding various, gold, silver, bronze, or platinum awards to various charities based on how transparent they are, how they're using their financials or the use of the revenue, but also board leadership practices. And so I think across the board, Guidestar is really looking at more things than just financials if someone wants to ensure that they feel like they're giving their money to a worthwhile organization.
That's great. Thanks, Justin. Question to Cindy Miller. Cindy, with today's low interest rates, is it better to take a mortgage or pay cash when purchasing a new property?
Oh my. Well, I think my answer is going to be a resounding maybe. I know interest rates on mortgages look very attractive right now, but what I'd want to do and what our team would want to do is take a look at each scenario individually. You know, give us a call and let us look at the return on investments, what the current rates are, what your current mortgage is if you have one, and then let's kind of tailor an option that suits best to you. So the answer might be yes for you and the answer might be no. So give me a call and we'll work through the numbers.
Great, thanks, Cindy. Question to Eric. We've been talking a lot about interest rates, but I think this question is really trying to get to the heart of, Eric, when do you think interest rates will go up again, not just a half, a quarter%, but back to 3, 4, 5%?
Oof. Chris, that sounds like a simple question, but it's not. I think to just put some kind of historical norms around that, historically, I'll just use the 10-year Treasury note as a starting point, has yielded over the past 30 years about 2 percentage points, which is 2%, but 2 percentage points more than the annual CPI, which is inflation gauge. So if inflation was 2%, the past 30 years, the 10-year Treasury has yielded 4%. So in that historical context, that is actually negative today. Inflation is greater now than the 10-year Treasury note. But what would it take for that to flip and yields to move higher, regardless of where Treasuries are, to create that more relative norm historically? It would take the Fed, as you know, we've all mentioned, kind of the Federal Reserve to reach their dual mandate, you know, full employment and price stability. And we don't see that happening in the very near future. And until the Fed takes a smaller role in stimulating the overall U.S. economy, it's going to be it'll be till that point, which if I had to say a time frame right now, they're saying 2022, late 2022. And I think that's a pretty reasonable time frame until you start seeing Fed interest rates return more to that historical norm.
Thanks, Eric. We have time for one more question to Cindy Miller. Cindy, what helps First Source Bank continue to be successful in Florida?
I think my first answer would be my colleagues that work with me as part of the Florida team. But my most important answer would be our clients and the faith and confidence they show in us each time they refer a family member or a friend or an acquaintance that they've talked to, even a business that they work with. Those referrals are the best compliment you can give each of us, and you allow us to be successful, not only for you, but for the other individuals in Florida that we meet. So thank you. Chris?
Well, as Cindy said, we love working with your family members, acquaintances, neighbors. So when somebody's thinking about Florida and they still live up north, please let us know. We'd like to walk them through all the information about things they need to think about and consider way ahead of the time they actually make the decision and load up the moving van. So we appreciate you being long-term clients of First Source, and our number one strategy in Florida is to make sure we can continue to service you even though you've moved south. So at this time, it's time to wrap up our webinar. We'll go back to the Selby Gardens and beautiful Sarasota Bay and the bridge in the background. Thank you for joining us. Goodbye.
We want to thank you all for taking time to join us today for, let's call this the Selby on Luncheon. Thank you for the questions that you sent in, and if you have additional questions, please just give us a call. We didn't want you to miss the Roy Lichtenstein Monet's Garden Goes Pop exhibit that opened here this past week. So as a special gift to those of you joining in, we'd like to invite you to the gardens as our guest. Give Lori a call in the office and she'll get you on the attendance list. Until we see you again, be safe. We miss you.